In this video, we'll break down the most important macroeconomic data released last week across the US, UK, Eurozone, Japan, and China. We'll explore inflation, employment, and business activity trends, and what they signal for the global economy and markets. Let's dive in. The US had a busy data week, but surprises were modest. Meanwhile, the Eurozone showed signs of improving momentum, especially in PMI and inflation. Japan quietly posted encouraging business activity data. Highlight: US, most data releases, moderate surprises. Eurozone, strong PMI and inflation beats Japan. Positive PMI momentum. Starting with employment data, the Eurozone had one data release: unemployment benefit claims. This was in line with forecast and an improvement on the prior month data. In the US, there had one data release: initial jobless claims. This release was higher than forecast and prior release. In Asia, Japan had one release, which came in line with forecast and prior. So the takeaways in regards to employment last week: it is very much a mixed bag of results, with employment improving in Europe, worsening in the US, and stable in Japan. Next on to inflation. Only the US and Eurozone released data last week. Of the Eurozone's two releases, both came in higher than forecast and prior reading. While in the US, of the four data releases, three came in higher: core PCE month-on-month, year-on-year, than the prior readings. So takeaway on inflation is both the US and Eurozone are seeing inflation tick upwards. Finally, on to PMIs. These provide a barometer on activity levels in the service and manufacturing sectors. In the Eurozone, of 9 PMI readings, 2 beat forecast, 4 beat prior. The beats came in Germany, while in France PMI readings are declining. In the US, of the 3 PMI releases, 2 beat forecast, but none beat prior readings. Let's summarize the global picture. Inflation pressures are re-emerging, particularly in the US and Eurozone. Business activity, PMIs, shows broad improvement, especially in Japan and parts of Europe. Labour markets are stable but not improving, a key risk moving forward. So what are some of the implications of last week's data, and as a macroeconomic investor, how could you play this? 1. Central banks face a tricky path. The Fed must balance sticky inflation against falling consumer demand. The ECB might delay cuts as inflation ticks up. Japan's rebound could stir policy tightening down the line. 2. Markets' reactions. Bond yields may rise if inflation beats persist. We have seen the bond markets have temper tantrums several times over the last 10 years when they feel governments and central banks are not managing inflation properly. Rising bond yields usually result in a flight to safety, which would mean positioning yourself in a safe asset to benefit from any upside pop if inflation does increase. This would be your hedge and downside protection. At the same time, look to invest in a risk-on asset that has upside when the downside risks dissipate. FX, weaker dollar. As we see a weakening in the US dollar, look for strength in other currency crosses, but which one to go with? As the UK, Euro and Japanese economies all look to have similar issues as the US, maybe they are a good short-term play, but a rotation in the future may see them go the same way as the dollar, if not worse. So look for currencies whose economy has stable monetary policies and safe haven potential. Swiss franc. Subscribe for more macro updates and drop your questions below. Thanks for watching. Stay informed and see you next week.